Hi, everyone, and thanks for listening to this presentation. So I plan to talk semiconductors with you, with most of my time during this presentation focused on why we believe we're in the midst of a semiconductor supercycle. I'll also provide an update about our current about the current supply constraints. However, if you are looking for a more in-depth outlook on the subject matter, definitely check out our recent published thematic piece on the subject. So here's our standard disclaimer. Just take a quick read before we move forward. All right, so here are the 5 key high-level takeaways I'd like everyone to really leave here from listening to this presentation. And we'll go deeper into all these concepts in the coming slides. However, first point, the supply constraints we see across a host of end markets today, we believe are transitory and completely normal when exiting recessions, especially a man-made recession like the one we had during the pandemic. We believe that chip demand will remain constrained through the third quarter for most markets and until year end for select cyclical markets before normalizing to more more historical levels in the first quarter of 2022. Second, AI, or artificial intelligence, is going to be the most disruptive force for the tech industry that it's ever seen, and will help accelerate a number of growth trends across the semiconductor industry, as smarter devices will require more complex chips. Third, we believe the industry will grow at a long-term growth pace of a very healthy, respectable 6% to 7%. Now that's using our 2021 revenue estimate as our base case, as 2021 will be somewhat of an outlier in our view, with growth or projected growth in our view of about 15%. Now, in terms of risk, as always, when the market gets overheated and you have supply constraints like this, customers at times will double order, essentially creating a pull-in effect on demand. In our view, demand is running a bit above trend line at the moment, and we would expect some sort of double ordering to take place in certain aspects of the supply chain. Also, geopolitical factors definitely remains a risk. We saw the impact trade wars and the Huawei ban had in 2019, when semiconductor sales for the industry declined 12%. So definitely something to keep an eye on. Now, what's interesting is the geopolitical concerns actually a positive for the equipment side of things, a negative for the semiconductor industry. Now, finally, from an investment perspective, you want to be exposed to the industry market share takers and content winners as we embark on an increasing AI-driven world. And for those that actively read our research, these tickers that we have highlighted should be of no surprise to you. And we think a decade from now, these will be among the biggest winners for investors within the semiconductor universe. So here's just a chart that shows the pain points in terms of the current supply constraints across the chip industry. Now, while all the talk usually centered around advanced technology nodes for the industry, and rightfully so, it only represents about 18% of the total number of chips sold into the market today. So think about Intel's CPUs at 10 nanometers. You've got AMD, NVIDIA's GPUs out there at 7 nanometers going to 5 nanometers. And of course, Apple with their A14 Bionic chip that powers the iPhone, the iOS on the iPhone, as well as its M1 silicon chips on its Macs. They migrated to 5 nanometers last year. So, and Apple will move to 3 nanometers in late 2022, according to our estimates, which remains in development. Now, that said, the highest volume of chips still comes from the more mature trailing technology nodes, over half of the semiconductor volume. It's that blue shaded region here in the chart. Now, while we're seeing supply constraints across all components and end markets, the magnitude of the constraints is very different. And as most are aware, really the biggest constraints today are being realized within the automotive and a host of industrial markets, because these segments rely more heavily on these more mature semiconductor components and were shut down during the pandemic and were required to quickly ramp back up as the economy recovered. Now, when it comes to capital spending plans now, foundries typically invest in the more advanced technology nodes just because it offers the greatest return on investment on their end. So you're not seeing as much kind of investment or capacity upgrades on some of these more mature chips. Now, some of the biggest constraints being seen, you can see here, for power management, integrated chips, microprocessors in cars, image sensors, high voltage, and a variety of analog components, among other areas. Now, in this chart, we illustrate the change in average days of inventory from the peak, which was the second quarter of last year, to current levels, or the most recent first quarter, for some of the biggest automotive industrial semiconductor suppliers, where most of among the most severe constraints were taking place. Now, while the decline has been pronounced for some, it doesn't tell really the full story, as inventories across the channel for the entire chip industry are at the lowest level seen in more than 20 years. And we'll need to take several quarters to really restock once we move past the more seasonally strong Q2 and Q3 quarters. In fact, most chip makers within our coverage universe will likely need to increase channel inventories anywhere from 20% to 50% once they're actually caught up with existing demand. And the good thing is that should provide a buffer for chip makers, and once end demand begins to normalize, as it'll allow these chip makers to really manage a relatively soft landing. Now, from a supply perspective, we've heard some good things from companies like a GM, Volkswagen in recent weeks, where we're definitely kind of in the midst of some very tough conditions, but they do see kind of a light at the end of the tunnel by the end of the third quarter, and it kind of goes in line with our assessment that the worst of the supply constraints should start to abate as we kind of go into the fourth quarter. So here's just a high-level, long-term view of the semiconductor industry. The chip industry has seen a number of transformative changes over the last several decades. You can see here the PC internet age started back in the 90s, and the shift to mobility in the early mid-2000s. And each has really supported an acceleration of growth for the space. Now, starting in 1960, it took about 40 years, from 1960 to 2000, for the industry to reach 200 billion in annual revenue. It only took 17 years thereafter to hit the next 200 billion annual threshold. And we estimate that the next 200 billion threshold will be reached by 2024. So only about 7 to 8 years from eclipsing that 400 billion peak. And that cycle will be eclipsed even faster in the next cycle, in our view. So what's happening here? Well, we believe the industry now is in the very, very early phases of the biggest disruptive trend that we highlighted that we'll ever experience, and that's AI. Most of the AI-related investments today definitely focused in the cloud, but will spread out to other industries in the coming years. Now, looking forward, we currently forecast semiconductor growth, as we previously stated, about 15% in 2021, with industry sales hovering near 500 billion by the end of this year, largely reflecting the benefits from a global cyclical recovery. Thereafter, we see a compounded annual growth rate of, again, about 6 to 7% through 2030, with annual industry revenue to double by that point. Now, this will unlikely be reached in a straight manner, as we think current industry constraints and demand across a host of end markets are unsustainable. So our long-term bullish view on semiconductors and AI really largely reflects the semiconductor content per unit growth that'll be achieved in core markets, as kind of more of these complicated chips will be needed across a slew of markets. But just be mindful that it'll be a choppy kind of a choppy number of years. And when it comes to the semiconductor industry, there's always significant volatility within the space. So if we kind of look back 5 years, using 2016 as a base year, the industry is projected to see revenue more than 45% higher in 2021 versus 2016 levels. And that's the black line in the chart here, which we use as a base year again. And that implies about a compounded annual growth rate of about 10% over the last 5 years. Now, what's interesting is that semiconductor content per unit, which is that blue bar, is seen rising about 25% in 2021 versus 2016 levels. Now, this will outstrip the 18% projected increase in total units shipped over that span, which is that red line. So while we expect semiconductor growth rates to decelerate after a very robust 2021 as unit volume normalizes, we do expect the content growth will continue its upward trajectory and accelerate in certain markets. So again, reflects that ongoing idea that AI and investments in next generation nodes will create smarter, faster, smaller devices. Now, if we kind of take a step back, look again back to 2016, smartphones have actually seen the greatest content growth over the last 5 years. And that's really been driven by connectivity complexities associated with the shift to 5G, also the focus on more processing power, enhancements in both front and rear facing cameras, also having a significant impact on semiconductor content gains. Now, while the content gains will continue in the wireless space, growth will decelerate in 2022 and beyond, as nearly 40% of smartphone units this year, we estimate, will already have 5G capabilities, which has been by far the biggest jolt to that content growth story. Now, in contrast, the content growth story in automotive is just starting, with only about 5% of automobiles sold today tied to EVs, while the autonomous vehicle story hasn't even started yet and will add some significant fuel to that content per vehicle story over the next 5 to 10 years. So here we just highlight some of the most important devices and markets in terms of future growth for the chip industry and the sharp rise in silicon content growth that'll be seen over the next 5 to 10 years. The largest semiconductor end market, smartphone, will see content per unit growing at an annual pace of over 13% over the next 5 years for high-end devices, again, driven by the ongoing adoption of 5G. On the data center side, over here, you've got semiconductor content growing at a more pronounced 19% annual pace through 2025, with sales growth for accelerators that being stuff like GPUs and FPGAs far outpacing that of CPUs, as an increasing amount of customer capital spending dollars continues to shift towards the high performance chips that can better serve AI needs of cloud service providers. And of course, there's going to be notable memory growth being seen in the data center, reflecting an explosion of data growth occurring. Now, on the automotive side, we see annual content growth of 10 to 11% over the next 5 years, primarily, again, driven by the shift to hybrid, fully electric vehicles, as well as autonomous vehicles in time. And again, we would highlight that this growth only reflects the silicon increase in a car. In actuality, the revenue potential is significantly higher when factoring in the hardware and software opportunities for these companies. Now, in terms of the smart home, the dollar content will be more than double over the next 5 years, but that's from a much lower price point than other market segments, given the vast number of different types of products that chips go into, which have relatively low semiconductor content. So think about smart bulbs, doorbells, smart speakers, etc. So I earlier stated that we believe the semi industry, again, can grow at a long-term growth rate of 6 to 7%, or at least 2 times GDP, using projected 2021 revenue as the base year. We break down the industry into six segments and show you how we think you get there. The two biggest segments, wireless and computing, make up about 2/3 of industry sales. Wireless, the biggest segment, driven by smartphones, as well as higher infrastructure spending on the back end. And while content growth will still be important to the story in this category, we forecast growth below that of the broader industry, given our lackluster outlook for smartphone unit growth. The computing segment, largely composed of PCs and servers, this segment will be driven by higher cloud spending from the cloud service providers. And that's going to be driven by two main factors: robust data growth and the rising interest in AI capabilities. And while we think PC sales will cool off in 2022 as a surge in demand from the pandemic will be digested, we think the PC space is undoubtedly in a much, much better position today than it was prior to the pandemic. The other 1/3 of the semiconductor industry is largely composed of the more cyclically driven consumer, industrial, and automotive markets, all of which we see running at or ahead of the broader growth outlook for the industry. So there's a lot going on in this slide. Let me kind of break it down for you. Memory, such a huge part of the semiconductor industry, now represents close to 30% of total industry revenue, and that compares to only about 12% 20 years ago or at the start of the century. Not surprisingly, we expect the memory space to witness the greatest content growth among all the areas of the chip industry. Really reflects the high price elasticity associated with these chips as prices go down over time. Now, on the top half of this slide, You have NAND memory, which we expect to eclipse 30% in annualized unit growth over the next 5 years. Over 90% of that demand for NAND memory comes from two end markets: mobile phones and solid state. Solid state essentially found in data center servers and PCs. Over 90% of the industry supply, you can see, is controlled by 5 players in that pie chart there. On the bottom, you have the other main memory component, which is DRAM, which will grow at a slower but still healthy annual mid-teen percentage base in the coming years. The key growth driver for DRAM will be on the server side going forward. It's about 1/3 of industry sales for DRAM, and a new Intel server cycle did start in Q2. While PC exposure, it has been declining in importance. I think it's only about 17% of DRAM sales at this point. So all in, we expect a more attractive supply-demand landscape for the memory space the remainder of this year. That'll help support a better margin profile and profitability across all the industry players. So just wanted to throw a slide here on the chip equipment space here. Even though it's not the focus of our thematic piece, however, we've received a number of inquiries about this space from clients as of late, so probably makes sense to highlight. We do think these last 3 years have significantly changed the landscape for the chip equipment space, and the environment looks very attractive here over the next decade. So if you're not familiar with the industry, it's really being driven by 3 big players, as well as a host of the memory providers. So you've got the likes of Taiwan Semiconductor spending $30 billion this year, up from $17 billion last year. And earlier this year, it said it plans to spend at least $100 billion over the next 3 years. So that's providing significant visibility. Intel's new CEO has the company shifting towards a more capital-intensive foundry-based business model. That also bodes well for the equipment providers like Applied Materials, Lam Research, KLA, ASML. Now we highlight some of the key catalysts here for the industry over the next decade that should allow the equipment space to grow in line with that of the broader chip industry. So that includes Taiwan Semi starting to mass produce 5 nanometers, now soon 3 nanometers chips. And it's aggressively, as it aggressively ramps into 3 nanometers, what's going to happen is it's going to drive other players to continue to invest heavily in those next gen technology nodes. You've got lots of talk about China aggressively building its local manufacturing industry, and it's been going on for years. But now Apple and Applied Materials and Lam, among other device, derive nearly about 1/3 of its revenue from China, with most of its regional revenue coming from the expansion of newer local players in China. We highlighted the improving memory landscape, and that's going to likely translate to higher memory spending, which has lagged foundry spending to a degree. Political drivers also emerging as a potential catalyst for the space. China controlling an increasing amount of the technology supply chain now creates the need for the US and Europe to both increasingly look to raise their own or increase their own chip manufacturing presence, which we think will be done via smaller and less efficient fabs. Now, finally, just an improving landscape for semiconductors, partly through greater semiconductor content, will continue to propel the industry revenue higher and thus greater equipment revenue over time. So over here, this is a list of some of our top chip names. You can find the full list in our thematic report, but if you've been following our semiconductor research, again, you shouldn't be surprised by the names on this slide. We highlighted earlier that the biggest winners will be the share takers and content winners over the next decade, with a particular emphasis on AI-oriented names. So some of our favorite names in terms of kind of the market share takers, clearly going to be AMD, where they're taking significant share on the server market versus Intel. We think that continues for several years. We also like the presence that AMD has on the GPU side of things alongside NVIDIA, and AMD also in the midst of acquiring Xilinx, and it's going to help give them just kind of more complementary chipsets, and we think that's going to be a huge boon for them. Broadcom, also a name we like, that's more the connectivity play on the 5G side of things, but we also like their dominant position in router switchers, as well as kind of their stable presence in terms of the infrastructure software side of things. Micron would be our top play in terms of the memory side of things. We really like what they're doing in terms of improving the balance sheet on that side of things, and we see significantly higher free cash flow from that company for the years to in the years to come. And we think if there's any company that could be re-rated in terms of the multiple, this would be the name within our coverage universe. And then if we're looking at kind of names with the more auto cyclical tilt out there, it would be NXP Semiconductors and On Semiconductor, two names where we think kind of at the heart of kind of the EV, AV play, and definitely going to be a content gainer beneficiary for years to come. And there you have it. I want to thank everyone for listening, watching this presentation, and definitely visit our website at advisor.marketscope.com for more information on the thematic tied to this presentation, or to get details on any research about the companies within our broader coverage universe.